So Matt, take us back to day one, for those of us that have only a high level understanding of the particular scheme itself, and what was the precursor to your involvement?
So thank you, Warren, and thank you all. Let me start by just saying it is an honor and a privilege to have been invited by Donna and others from the firm to come from New York to make these presentations. It is the highlight of a career for sure to have worked on the Madoff engagement. And I'm fortunate enough to have been on the ground since day one of this investigation. FTI was originally retained all the way back in December of 2008. The matter is still ongoing. We are still working. We still have a team of maybe more than a dozen professionals that are full-time on the Madoff investigation, because we are, and this is part of what we'll talk about over the next hour, is the recovery effort has been just phenomenal. And we'll talk about the numbers and how those recoveries happened. But we still have 50 active litigations in bankruptcy court to recover yet billions more for the victims. And so one thing I will start with as kind of a caveat is I'm still an expert witness testifying in active litigations. So what I talk about today, for the most part, I'll try to keep it as much to the work product from FTI Consulting, the opinions that are contained in my reports, to the extent questions come up and it's my own theories that are outside the report. I'll caveat those and I'll only share with you what I think is appropriate because of ongoing litigation. But we've been involved in this case since December of 2008. FTI got the phone call to be part of this because when Bernie Madoff was arrested on December 11th of 2008, in the United States, when a broker-dealer goes under and has fraud or shuts down or has allegations of fraud and starts being investigated, the organization called the Securities Investors Protection Corporation, which is a financial industry funded organization, is responsible for stepping in and doing an orderly liquidation and wind down of a, for lack of a better phrase, broken broker-dealer organization. And so obviously this news hit the press in December of 2008. 1 out of every 3 stories in the Wall Street Journal and on every TV show was a picture of Bernie Madoff, arrested, fraud. At the time, it was thought to be a $50 billion fraud. That actually was an understatement. It was a $65 billion fraud. And this was all over the news. This was everything. And so as part of the orderly liquidation, the Securities Investors Protection Corporation, or its acronym SIPC, you may hear me use throughout this, is the one that runs the wind down. And so they appointed Irving Picard as the trustee to do this work. Irving is a partner at the law firm of Baker Hostetler. And so Baker Hostetler was then tasked with doing this wind down. Obviously, one of the multiple of the key areas of expertise they needed assistance with was the financial advisory work, the forensic accounting, the investigations, the computer technology expertise that FTI can bring to bear. And I was fortunate enough to be on that team that got started right away. So we got the phone call, and just like all of the work that FTI gets, it's based on relationships. And I tell all of the younger staff, or really anybody who will listen, the reward for good work is more work. And so when you do, we had just come off of a really big assignment with some of the Baker Hostetler lawyers. We were working with Baker Hostetler in 2005, 2006, 2007. So we were there and able to jump in on this. So we got this call. My first day working on the Madoff investigation was the day after Christmas, December 26th of 2008. So we're coming up on finishing our 17th year in this matter. And for the first 2 years, it was full-time for me. It was my team and we worked in the offices of Madoff's operation. And we were tasked with 2 primary exercises from the very beginning. One was the fraud investigation. What exactly happened? Who knew what and when? Was there some trading and some lying? Was there mostly lying and no trade? So we didn't know when we first got there. But exercise number 1 was the fraud investigation, was what the heck happened here and how can we uncover it and document it so that we can prove it we were aiding the FBI and the criminal investigation. What was somewhat new to me in my career, I've done it a few times since, but when we started, he was arrested on December 11th. We technically were working within a crime scene. All of Madoff's offices were designated by the FBI and the government as a crime scene. And so we had FBI agents that were working all around us. We had to get an FBI escort when we went to certain areas of his office to go look through files. Every day or every week, an FBI agent would come up to us and ask for numbers because we were crunching all of the numbers and going through all of the records at a much faster pace and I think much more qualified pace than a lot of their team was able to do. And so working in a crime scene was quite fascinating. So task number one, when we very first got there, was figure out what the heck happened and how it happened and what were the mechanics of the fraud. And I can definitely answer questions about how a Ponzi scheme works and what is a Ponzi scheme and all of that. The second task, and I'll come back to you in a second, Fiona, the second task was reconstruct the books and records. So I know I'm talking to a room full of attorneys. At the end of the day, all of this work from the trustee's perspective is only as good as it can be to turn our findings into recoveries and financial recoveries for the victims. So the second and now larger part of the project, and the part of the project that has continued on for 17 years and will continue on for many more because of all of the active litigation that's still out there, was reconstructing the books and records so we can figure out who were the ones that made deposits, who were the ones that made withdrawals, when did they make those withdrawals, when were people paid with stolen money, and can the trustee recover those stolen funds through bankruptcy court and through recoveries. And you've heard the phrase clawback actions, all of the clawback lawsuits and fraudulent conveyance lawsuits that were filed in this case. So that was all FTI's work product, was the analysis of the fraud and the reconstruction of the books and records. And we had Fiona had a question. And so the question, for those of you who couldn't hear it in the back of the room, was 17 years of work has gone into this, but do we know when the fraud actually started? And so I think it's interesting, one of the first questions I got from a lot of people when this work started is, how are you ever going to figure out where the money went? And the irony is that's like the one thing we were able to do, I won't say fairly quickly, but the investigation itself had to be done in the first 2 years. So we've been working on this case for 17 years, but only a year, between 1 and 2 years, was the investigation and the analysis and the reconstruction of the books and records. A trustee has 2 years from the date of the petition date, the filing of bankruptcy. You have 2 years to bring causes of action. So our analysis had to be done by December of 2010. So we're working on this for 17 years, but partially that's because the wheels of justice move slowly. Litigation takes an enormous amount of time. And for those that bill by the hour, that's not a bad thing. And so for this time period, the most of it has been litigation and expert witness work and that type of litigation recovery. The investigation itself was less than 2 years. The fraud itself, what the investigation uncovered, is that the fraud itself, notwithstanding that Mr. Madoff claimed from the very beginning that his fraud started in the late 1990s and that everything was real and legitimate until 1998, and it wasn't until 1998 that he started his Ponzi scheme. We know from the evidence that we've seen that's not true. The Ponzi scheme lasted at least 30 years. It started in at least the early 1970s. We have testimony from one of his oldest, at the time he was one of his oldest former employees. He's now since passed away. But a gentleman by the name of David Kugel, who testified and cooperated with the government, he said that he started work with Madoff in 1971. And his first assignment when he started in 1971 was to backdate and falsify trades to generate the returns that had been promised to customers.
So that's a little bit of a pin drop moment there. So right from the get-go, we was never trading. It started the fraud. Matt, perhaps then pivot into maybe build that layer cake that is the different businesses that sat on top of one another. So obviously you've just now talked around the Madoff business that was fraudulent from day one. What were the other components to it?
So and there may have been some trading. So Bernie Madoff started managing other people's money. And the big part of his fraud was something called his investment advisory business. And anybody who's ever invested with a wealth management professional, you give him or her power of attorney and you agree with their strategy, whatever their investment strategy is. Are they buying mutual funds for you or whatever it is? Madoff had 3 different business units, the biggest of which was where the fraud took place, which was his investment advisory business. This was the business where you sign over power of attorney, you give him your money. He's not interested in you telling him, hey, I think it's a good time to buy Amazon. Let's buy Amazon. Or I want you to buy this stock or sell that one. He wasn't interested in any of your advice. You were just giving him money and he was putting it to work using his strategies. And that's not unlike other wealth management people. What was different about Madoff was he had this air of superiority. He had a reputation on Wall Street, and you almost had to know somebody to get in, which was part of the exclusivity and part of what made him that much more of a draw. But how did he get that reputation? And how did he get that Wizard of Wall Street reputation? He actually started with I'll call it a more legitimate business. And I can't call it a fully legitimate business because the financial reporting around this business was infiltrated with the fraud and commissions from his investment advisory business. So there was false financial reporting in everything he did. But he had a business where he did do legitimate trading. He had something called a market-making business. And a market-making business is essentially just small volume, and it's a service provided to the marketplace to help match buyers and sellers of stock. And so if somebody wants to buy 1,000 shares of stock and they can only find 955 of them from a variety of sellers, a market maker will fill that gap. And there's money to be made in filling that gap with small amounts of shares in a lot of different securities. That was the business that Bernie was in, that was public, that was out there, and had legitimate trading with it. So he had a market-making business. He had a proprietary trading desk within his business, which is where investment advisors will, or financial institutions will trade their own money. And then he had this investment advisory business. And the investment advisory business started small with clients that he got referred from family members and things like that. So in the early days, maybe in the 1960s when he started, he might have been trading. And I don't know enough because we don't have the records to go back this far. So this one is not a Madoff story. This is just a general discussion of frauds like this. And anybody who's done fraud investigation in the trading space, you know that a lot of times what happens is it doesn't start with the intention of committing fraud. It starts with, I'm going to be really good at my job. People are going to give me money and I'm going to win. I'm going to pick winners. We're not going to lose. And then you might have a good quarter, then you have a bad quarter. And you don't want to tell your clients you lost money. So what do? The next quarter, you take a little bit riskier gambles, you hit on those, you fill the gap of what you lied about in the first month, and nobody needs to know that I had a bad quarter and I can stay that I always win. Well, what happens in a lot of these frauds is the second quarter, you take those risky gambles and you lose again. Now in the third quarter, I got to take even riskier gambles and I lose again. And now I've dug this hole I can't get out of. So it is certainly possible that in the 1960s, that is what happened with him. But we know that starting in the 1970s, he was already falsifying trades and had already started to commit the fraud. So how exactly it started before 1971, that we still don't know. But we know it was happening, and we've seen the paper records. We actually have found the evidence of adding machine tape, where you could see the calculations are reverse engineered, where it starts with the profit needed to get this client a 12% return. What trades do we need to make to get them there? And it works backwards to get to what shares do we need to show, and then those are shown on a statement following the adding machine tape. So we have all of that kind of evidence. But those were his businesses, and those were the ones that kind of created his name and what led to his ability to do this, to have this fraud.
And of that question?
So again, and I'm going to repeat them just in case because people are facing me this way. So a fraud that lasts that long, how many co-conspirators and people on the inside have to help. So I believe I'm gonna say an outrageous statement about the Madoff fraud, because I think of all of the outrageous things about the Madoff fraud, the most outrageous is the fact that his statement in December of 2008 that even got any attention at all, and news reporters picked up, was that when he said in December of 2008, I acted alone. I did this all by myself. The fact that anybody picked that up and gave that any credibility, even for a moment, is ridiculous, because your point is a valid one. Nobody could do this alone. And one of the things that happened when he was arrested, the first $1 billion of recoveries was Madoff's net worth. Like, his net worth was $955 million US dollars. And so the first thing that the government collected was his net worth, leaving his wife with a controversial, relatively small, but controversial amount of money. But he had $1 billion of net worth when he had a chateau in France. He had a yacht that was named the Bull. He had a penthouse apartment in Manhattan. He was not in the office making up trades. I mean, obviously he had a team of people that was doing this. There was a core group. There were employees who were working in the market making business who were insulated from all of this. But he had a core group of between a dozen and 24 employees who were putting together all of these financial statements and false financial reports and false customer statements and the fake trades. 24 people that were working on it, many of whom cooperated with the criminal authorities, many of whom didn't and faced a 9-month criminal trial and were indicted and sentenced. So there was a team of people that he had working with him. David Kugel is the name I gave you. That was one of them. So he had a team of people who helped him do all of this.
It's an interesting fact that a number of his relatives, his sons and daughters, were working in that market making business, and that's where you start to go, how disintermediated were they around the knowledge of what was happening 2 floors below? And that's something that when you look at who was indicted and who wasn't indicted, they missed necessarily being caught in the trap that Bernie was.
Yeah, so I get that question a lot about what did the children know, what did his wife know. You know, FTI did not get involved directly in the criminal investigation component of it. As I said, we were working in a crime scene and FBI agents were around us all the time. And we were helping to feed them questions to ask the cooperating witnesses, questions to ask Bernie himself when he was interviewed in prison. But the children and his wife were never convicted, were never indicted, never convicted of a crime. What they knew or didn't know, you know, has still not totally been clear. This whole thing is a human tragedy story. Both boys are deceased, and a lot of the players in this now have passed away. But yeah, absolutely, it was, you know, his family was involved. His brother was one of the early convictions. How would you like to have this on your resume? His brother was the chief compliance officer of Bernard L. Madoff Investment Securities. He was arrested, his outside auditor. After Bernie was the first arrest, the outside external auditor was the second arrest for not doing an audit. And that investigation didn't take long. He basically said, yeah, cuff me. So there was no external audit component and all of that.
As Matt talks through the case, you start to see these red flags appear. And in hindsight, when you add them all up, you go, of course. But just something for us to, you know, be cognizant on as you're listening through. And you make a good point around the auditor. Tell us about the reputation of the auditor. You know, high street, large scale, listed. No. Who were they?
You know, as you sit here in this beautiful office here in Melbourne and look at the Melbourne skyline, you could see, you know, the buildings that have Big Four accounting firm names on them. He did not have a traditional audit firm. He was audited by the firm Freeling and Horowitz. And of that's a 2-person name, and it was a 2-person shop, and 50% of those names were already retired. So there was a 1-person, 1-man shop that was essentially supposed to be doing his audit. So, you know, a lot of the questions I'm sure that will come out and are currently rattling around your brain are what were the investors doing from a due diligence perspective? There were folks who spoke to, some of the big hedge funds did reach out and talk to the audit firm. And so that's a big part of why that auditor was indicted right away, is he was implicit in this, complicit in this fraud. And, credibility-wise, is that who you want auditing one of the largest hedge funds in the world that's going to give you the warm, fuzzy feeling at night that you can say, all right, somebody's looking out for me? Obviously, the regulators, they've got lots of questions to answer to in all of this of how this lasted as long as it did. But these red flags, who the audit firm is just one of them. We found so many different things about red flags about the fraud itself. So the question in the back was, a lot of these frauds, there's like one thread that somebody will pull on, or one whistleblower who will raise an issue, and then that will lead to the FBI investigation. In this particular case, there were red flags. There was a big whistleblower that I'll talk about in a second. Sadly, none of that is what led to the downfall of Madoff. The only thing that led to the downfall in Madoff was the global financial crisis of 2008. Because for every Ponzi scheme, and there are Ponzi schemes, I know there's big ones here in Australia. There are Ponzi schemes that are going on right now that we don't know about yet, that something will unravel those. At the end of the day, a Ponzi scheme can only last as long as you have more money coming in than you have redemption requests and demands for money to go out. And so all of the documentaries and things that are out there talking about the Madoff story talk about how, as this was getting bigger and bigger, he had to go find more and more investors. And he went into the European markets and big hedge funds in Europe because he needed a new infusion of billions of dollars in the early 2000s. Well, what brought this down wasn't nobody gets credit for saying, aha, I got you. He couldn't keep up with the fact that in 2008, the market is collapsing, and investors in the ordinary course of living their lives are withdrawing funds from their investment accounts. And the funds being withdrawn, and a lot of his customers weren't necessarily direct customers to Madoff. They were customers of hedge funds who just took their customers' money and gave it to Madoff. And so those hedge fund clients were withdrawing money and redeeming money from the hedge funds. The hedge funds in terms are telling Bernie, hey, I need $1 billion this month because my clients are asking for their redemptions. So in the 3 months, 90 days prior to the bankruptcy petition date of December 11th, 2008, he had $6 billion of redemptions that he paid out. He had more redemption requests that he just ran out of money. So this crashed and the house of cards fell because he couldn't keep up with redemption and money, the run on the bank. That being said, along the way, there were lots of threads being pulled and there were lots of people questioning this. The single biggest red flag in all of this is, if it's too good to be true, not that it automatically is, but it could be. It's worth digging into a little bit deeper. His market strategy, his marketing strategy to his customers was, hey, I am going to provide you with a safe, hedged opportunity that, you could do better at, some of the more risky hedge funds. They might get you 35% one year and then lose 12% the next, and then get you 25% the year after that, but then lose 40%. He's like, I'm going to get you 12 to 15% every year, good markets and bad markets. And if you look at his stock charts and the equity growth, it was just a straight line up. Red flag. Is that something that anybody can do with that level of consistency in good markets and bad markets? No. But that was what he did. And a lot of people looked at his activity. And when FTI got there, two of the things that we did to do the fraud investigation was, one, we reached out to a lot of sophisticated hedge funds and investors who did due diligence and chose not to invest with Madoff. We wanted to interview them, and we wanted to find out, what was it that you saw that made you say, I don't trust this guy. I can't make sense of his trading. It's too good to be true. We wanted to hear that from them because that was going to educate us on where to look internally for red flags and proof that there was a fraud going on. So talking to the people who did due diligence and chose not to invest was huge. Another thing we did was we sent out what in the audit profession we would call negative confirmations. At the end of the day, you're trying to prove a negative here, prove the trading didn't take place. And so to prove a negative, you basically have to look at it from as many different angles as possible and try and reach only one conclusion, that there was no trading. So if there were trades, there's got to be a counterparty somewhere in the world. So we sent out confirmation letters to like 30 financial institutions that would have been some or all of his counterparties. We sent out 30 different letters and reached out to, we got a lot of no responses and no comments, but we got a lot of responses that confirmed, correct, I have never been on the other side of a trade with Bernard L. Madoff Investment Securities. So that was all a big part of what we were doing to prove that the trading never took place.
I might pause there. Any other questions coming through?
So the question is, and one of the red flags is the incentives and the amount you have to overcompensate employees to do this. Well, he, like a lot of frauds, most of the people working with him in this part of the business were woefully unqualified to do anything in the financial market industry. A lot of them either didn't have even a high school diploma, or that's as far as their education, only a high school education. And they were very well compensated, people with $1 million mansions on the beach and things like that. So there are also some of the employees that over time realized that, wait a minute, I've been asked to do these things and I didn't really understand what they were. Then they started to learn that they were part of a fraud who extorted him for more money, very small sums of money compared to what they should have extorted him for. I think one of them basically got, like 50 grand and a watch. You need a better agent. I mean, that's terrible negotiation. But so they were very well compensated. A lot of those 24 people that were working on this were just data input clerks who may not have known what they were doing was wrong. So we did get cooperation from employees, some of them. And those that didn't cooperate, they fought and they were convicted, but absolutely they were well compensated along the way.
So it's an interesting, you segregate the activity that they're doing, you compensate them particularly well, and you're employing a certain level of understanding. Easy then to break down. If I don't know the end-to-end value chain of this fraud, why am I thinking it's fraud? I'm having a great time. I think there was a question around the attrition previously, and there was relatively low attrition in the organization because everyone was very happy. They're all getting rewarded.
Where with a high school education are you going to go somewhere else and make a fraction of what you're making working in this? So there was not a lot of turnover in his employees.
You made a great point around the red flag there. Around the regulator came in 6 times to look at different components of this, and I think Matt, you talk a great story around how prepared Madoff was, and then perhaps if you can pivot into your relationship with the FBI, as you say, you're in the crime scene. What was that sort of dynamic between the two of you?
Yes. So I'll lead with the second part and then come back, because there is one particular whistleblower that I think everybody needs to understand. But so we were working in the crime scene. FBI agents were floating around. They are interviewing, and we don't have access. We're not, I would have loved to have sat in the interviews and the interrogation of employees. But at times, we're being asked questions about volume of deposits and withdrawals over periods of time, and the FBI agents who are then going to go interview the cooperating witnesses. So one of the things that gave us one of the biggest senses of pride in all of this was Madoff's number 2, his key employee is a name, Frank DePascali. Anybody who's seen the videos and the movies and Robert De Niro's movie, Frank DePascali is the guy who just had a high school education, wasn't trained in financial markets, but he's the one fielding customers' calls about the trading strategies and things like that. He cooperated. When his information came out, it was like a 45-page document that the FBI had prepared and worked with him to come up with his information and essentially his testimony. My FTI colleagues and I all gave each other a high five in the hallway because it read exactly like everything we had written up. All of the red flags about the way in which the trading was falsified, all of the ways in which they created these false trades through Excel spreadsheets and all of this. He described, because we had provided the FBI with our findings, the FBI confronted him with them. He confessed and gave slightly more detail, but only slightly more detail because we had it all already. So that was fascinating to be able to do that. Another thing is we were there as it was happening. And my wife loves to tell the story because there's one story where at the end of this, so what ultimately collapsed this was he ran out of money. He could not keep up with the redemption demands. Well, at the end, and one of the things that we talk about in this case is we use the 4-letter word only in front of sums of money that should never have the word only in front of them. And I'm going to use one of them now. In the bank account, as this went under, he had only $170 million left in the bank. But he had $170 million in the bank. He's dealing with billions of dollars of redemption requests that he can't pay. But he's not sinking on this ship without spending, or at least trying to spend that last $170 million. So he wrote out 100 checks totaling $170 million to go to your point of some of it went to the employees, some of it went to close friends and insiders and account holders. There was a list of 100 checks totaling $170 million. He never got the chance to give those checks out. But one morning, my wife and I are, getting ready to go to work, and along the ticker at the bottom of the news report that morning, it says FBI, not FTI, should have said FTI. FBI identifies 100 checks totaling $175 million that was to be distributed by Madoff. And I'm shaving in the other room, and my wife yells, "Did you know about that?" I said, "Yeah, they handed me those checks yesterday. I added them up." And so, we were in there while this investigation was going on. So for what we as forensic accountants do, this was the pinnacle of a forensic accountant's career. So that was the kind of what it was like to be there in the crime scene while it's all happening. A conference room where we were working and the floor where we were working, we had to close the window shades because there was photographers, journalists, paparazzi trying to take pictures of us in Madoff's offices for that first 6 months after all of this happened, because like I said, it was 1 out of every 5 stories on the news, and everybody wanted to know what's happening in Madoff's offices. So we had to close the window shades because people were taking pictures from across the street, and it was quite fascinating. So if we want to go on to red flags or the whistleblower.
Yeah.
So there was one key whistleblower in all of this. There were lots of people who raised questions. There were lots of people who I said didn't invest and always had questions. There were a couple news articles written, but the biggest one was a gentleman by the name of Harry Markopolos. And he was a mathematical quant expert for a hedge fund in Boston, Massachusetts. And he was tasked by his boss, who had the hedge fund in Boston, and said, "There's this guy in New York named Bernie Madoff. He's getting unbelievable returns, consistent, solid. His clients are loving him. He's killing us. Why can't we sell the product he's selling? Why can't we find out what he's doing, mirror it, make it a little bit better, and sell that to our clients?" Good business strategy, right? If somebody's out there doing it right, you want to meet that, beat that, and sell that. So good idea. So he tasked Harry with trying to reverse engineer Madoff's trading strategy, at least as it was reported to the world, and they were going to then try and sell it to their clients. So Harry, if you believe Harry Markopolos, it took him less than 4 hours to reach the conclusion that Madoff was a fraud. He said that he understood Madoff's general strategy, and he had customer statements for some of the customers. He looked, and the strategy was a hedging strategy. And it's a legitimate trading strategy that's out there in the world called the split strike conversion strategy. And this is what Bernie sold to his people, which is, I'm going to go long. I'm going to buy a portion of big stocks, blue chip stocks, the S&P 100, like some of the biggest name stocks. But I'm going to buy not all 100. I'm going to buy 40, 45 of them. And you can't recreate what I do because I know the market better than you do. I know when to get in. I know when to get out. I know which ones to buy. So if you try this strategy, you're not going to be as good at it as me, and you may not get the positive returns I get. So what he did was he claimed to buy, call it 48 of the S&P 100 stocks. And he would hedge them with puts and calls and options against the S&P 100 index. So he's hedging with options against the full S&P 100 index, but he's choosing half of them to buy the equities. That was his strategy. That's what he told people. And that's what showed up on people's customer statements. Never actually bought all of this, but just reported it. So when Harry Markopolos looked at what Madoff had done, he said, okay, if I understand how much money Madoff claims to have as assets under management, which at the time publicly was only a fraction of what he actually had, he recreated it and said, hold on a second. For him to employ the strategy he says he's employing, there are literally not enough options traded in the world on a daily basis to hedge what he says he's hedging. So he wrote up and I think if he went to the SEC and explained it in the 3.5-minute version I just gave, it might have gotten more attention. Instead, he wrote up an overly complex 45-page dossier with mathematical formulas and just overcomplicated everything, because that's what this mathematical quant brain, is. And so the SEC, how many unsolicited, feedback do they get from people? They first ignored it. Then he sent a second one. They continued to ignore it. Then he sent a third one. And finally, they met with him and couldn't understand a word he was saying. Then he continued to follow up. And they finally did go talk to Bernie about the things. But he had answers to all of their questions, and it just kept going. And so the SEC did multiple field audits and regulatory audits. And, I don't think they necessarily thought they were going to survive them all, but they did.
So an interesting insight into how we treat whistleblowers. He had the right answer. It was the way in which it was delivered, backed up with, Madoff's too big to fail. He is the head of the SEC, the stock exchange, etc. So, balancing off the brand and the bravado with what was a technical dissertation there, but delivered by someone that wasn't perhaps as articulate as they could be with regard to what was this burning fire, etc., etc. So we're in the lipstick building. Mm-hmm. We're engaging daily with the FBI, and they're taking all of your thunder and taking it as their own and pushing it out there.
I just like to think that whenever it said FBI, that was just a typo.
We've seen multiple red flags coming through there, but no one putting that whole picture together. It took a monumental interruption to the economic cycle to actually bring it all down. Take us through how you went back 30 years to do the tracing before then we pivot into the winners and losers coming out of this. Right. You've entered the building. What are we finding scattered across the floor that enabled you to actually do this retrospective?
Right. So everything we've talked about so far is really just background about how the heck he did this fraud and things like that. Now, how did the lawyers and the accountants do the work that was necessary to lead to these recoveries and, ultimately try to help out the victims here? And so what happened was when we got there in December of 2008, regardless of the size of any forensic accounting assignment or any fraud matter, the first thing you got to do is you got to get your arms around the available data. And this was no different than everything else. The one thing that made this case different was the sheer magnitude of it. And we could not have been as successful as we were if Madoff didn't save. Thankfully, he and his team saved so many records, so much material. Whether he saved it because he knew he was, maybe someday this would have been something to save him or leverage, who knows? But he saved mountains and mountains of paper records and electronic records. Keep in mind, we had records, going back decades, long before, all of the digital age we're in now, where everything can be on one thumb drive. We're dealing with tens of thousands of boxes of paper records. So when we got there, in the floor where the fraud kind of took place, behind a door with no names on it, just almost like a dungeon where all of this took place, there were mountains of paper. There was a file cabinet with every customer's 2008 monthly customer statements. There were files and folders of, when I went in there with my FBI escort, we found envelopes that might say June 2008 written on the outside. You open it up, and it's every day's Wall Street Journal for the month of June 2008 with handwritten notes in the margins to indicate which stocks to circle and say they bought. Then we were able to tie that to the actual customer statements that were created. But in terms of reconstructing the books and records for all of the account activity, we were able to recover paper records for the customer statements for calendar year 2008, electronic records for a 13-year history going back to December of 1995. On the servers, they had electronic copies of customer statements. And then in addition to the paper files he had in the office, he had paper files in the warehouse, I'm sorry, in the basement of the building in Manhattan where his office was, which is known as the Lipstick Building, because it's a red cylindrical shaped building that looks like a tube of lipstick. And so that's the nickname of the building. But in the basement, there were thousands of records. He had an offsite warehouse with thousands of boxes of records. And in one or two of those boxes, we found 10,000 reels of microfilm. And on that microfilm, if you think about, going back to the library as scrolling through old newspapers, we found 10,000 reels of microfilm that had 30 years of customer statement activity. While the customer statements were fake and falsified, the trading on customer statements was fake. The cash deposits and withdrawals reflected on every customer statement had to be 100% accurate, because one of the things that would have unraveled this instantly is if you made a deposit for $10,000 and it didn't show up on your statement, damn right you're going to call and say, whoa, where's my deposit? Like, you forgot to give me credit for my deposit. Or if you made a deposit for $100,000 and because this is all manual entry, it was a typo and they missed a zero and gave you credit for $10,000, you could raise that question and get that fixed. The cash had to be accurate, because when you turn over your power of attorney to an investment advisor, you have absolutely no idea and can't independently validate what trades he says he made for you. So when you get a paper statement at the end of the month and he says, I bought you 100 shares of IBM, you could go to the Wall Street Journal from 3 weeks ago and say, okay, he says he bought this quantity at this price. Yeah, that was the price that day. Okay. But you don't know that he bought it and he didn't buy it. But you can't critique that. You can't say, hey, this is wrong. But if he misses your cash transaction on your customer statement, you could. So we had 30 years of customer statement data and 10 years of bank records. So one of the big tasks that FTI did was we ticked and tied and validated every single cash transaction for that 10-year period with 100% accuracy. I mean, what reconciliation, we would have been satisfied if we got 92%, 95, 100% of everything tied to the bank records. So we had absolute proof from a forensic accounting perspective that the cash activity that was reported was accurate, tied to third-party bank records, because this was one of the things we had to defend ourselves in the litigation, was we didn't have the 11th year, the 12th year, the 13th year. We're going back 30 years, but we only had 10 years of bank records. So I'm able to say to the judge, and I did this in bankruptcy court, look, I'm not unable to tie out the 11th year because it's wrong. I'm unable to tie it out because we simply don't have the bank records. Based on the success of 100% of accuracy and the story I just told, which is it had to be accurate, we have every...
So it was a forensic accountant's Christmas all at once.
It was. And
now I'm going to try something different, because we're coming up on 10 minutes to go, and I promised to get you out of here by 9 o'clock so you can do your day job. We might do a bit of rapid fire. So you've heard chapter 1 and chapter 2 of Matt's 20-chapter book that covers this entire fraud and scheme in that regard. So I might take some rapid questions from the audience, and if not, I shall throw some at him very, very quickly.
Because we do have to get to the accounts and the net winners and
yes.
net losers and that. And that is a perfect segue into what we need to cover. So the question is,
10 words or less.
No chance at all. How many words was that?
That's right,
so
4.
The question was, what are we recovering? Are we recovering the original investment or the... So the growth reported on customer statements was pure fiction. And all of that, much to the pain and agony and discomfort of account holders, was ignored. It had to be ignored. It was made up. And so customers got no credit for time value of money, or, a lot of people were arguing, well, $1 million invested in 1990 is worth a lot, is a lot different than $1 million invested in 2008. However, people were we gave them the choice, figuratively, so to speak, which is you either thought you were investing and your broker was putting your money at risk in the market, or you were in on the fraud. Which would you prefer? So everybody had to acknowledge that they were giving their money and putting it at risk in the marketplace. People were not buying treasury bills with risk-free rates of return. So there are no guaranteed rates of return in this. All we could do is calculate people's actual principal. So we refer to your cash in as your principal balance. And so what we did with these 30 years of account records is, in all of my expert reports, I have an exhibit that is a chronological listing of everybody's deposit and withdrawal from the start of when they opened their account. And again, we go all the way back to 1978 with records. And so every deposit and withdrawal. And so I could tell you, every account holder, what their true principal balance was at any point in time. And we do that calculation so we can determine when an account has withdrawn more than they put in. And so that group of customers are called the net winners. They have withdrawn more from this Ponzi scheme than they deposited. And the net losers are the ones who deposited more than they withdrew. Meaning, if I put in over the years $2.5 million and I only withdrew $1 million, I still have a positive principal balance of $1.5 million. It would have fictitiously grown to maybe $8 million. So when Madoff crumbled, I have a statement, my November 2008 statement says $8 million. I've filed a claim, and everybody in December of 2008, including many people who weren't even Madoff customers, filed claims for that amount of their November 2008 customer statement. All of them were denied because that number was fake. The ones that had positive principal were eventually, when the analysis was done in 2010, they were granted an approved claim. In the example I gave, if you deposited $2.5 million and withdrew $1 million, you got a positive claim for $1.5 million. The people who deposited $5 million, but over the years had withdrawn $8 million, they were -$3 million. Their claims were denied, and that -$3 million is now the money that the trustee is trying to recover, because you were paid with stolen funds. The bankruptcy rules in New York limit us just to the 2 years prior to the bankruptcy. So if you took that $3 million out, one a year for 3 years, we could come after the $2 million that was taken in the 2-year period. You get to keep the other $1 million. That doesn't necessarily mean you won in this, because you thought you had 11 in your account or whatever the number is. So you lose the 11. So this is why it's a human tragedy story. Everybody lost access to their money. And one of the lessons to be learned here is the people who got hit the hardest are the ones who had all of their savings and all of their investments in one place. Nobody should ever have all their money in one place, because they lost access. They couldn't pay their bills. And that was a big part of the news at the very beginning. But the trustee's job was to try and recover money for that group of net losers. And the size of this fraud was $65 billion, was the assets, the alleged assets under management. That's the aggregate of all 8,000 accounts. What they thought they had in November of 2008 added up to $65 billion. The real losses from the collective group of net losers, the principal that people hadn't gotten out yet, was $20 billion. And that's the number that the trustee is trying to recover to get back to those customers.
Who was the largest net winner?
So in that group of net winners, the vast majority of the number of people were just innocent, good faith investors who had no knowledge of the fraud. And to use, the legal term, knew or should have known, is what the trustee used for a lot of these good faith and bad faith investor complaints. The vast majority were just innocent people investing, having no knowledge of the fraud, and didn't know that they were being paid with stolen money. There were plenty of insiders and bad actors and people that knew, or at least should have known. The largest one of which is a name that people who know this case know the name Jeffrey Pickauer. He was the largest individual net winner in all of this. He died of some suspicious circumstances. He apparently had a heart attack in 2009 and drowned in his own pool in West Palm Beach, Florida. But he was the single biggest net winner in this. We don't know his role in the fraud, but he deposited, again, I'm going to use the four-letter word only, he deposited only $500 million in his Madoff accounts over the years, but he withdrew $7.5 billion. So he was involved. We don't know exactly how, but a net winner of $7 billion. His widow wanted absolutely no part of any of this. And that money that he took out, he reinvested, and he had like $11 billion in a Goldman Sachs account. So the widow gave back $7 billion. So you talk about taking this case from where the world thought recoveries would be nothing or less than 10 cents on the dollar. We got $7 billion in one settlement. And so now the trustee has collected double that. We are over $15 billion in recoveries. The biggest piece came from that one net winner who was a bad actor. A lot of it, unfortunately, has come from net winners who were not bad actors, but who now we know were paid with stolen money. And the job of the trustee, although not a favorable one and not one that everybody, he has to sue net winners who are also victims to give their money back to try and level the playing field as best as we can. So,
3-minute countdown. Questions go.
So one of the biggest, I think, value add that FTI brought to this was individual customers were granted tax relief from the IRS because they were paying taxes every year on their earnings. And so US taxpayers were able to, on subsequent years, get tax relief and tax offsets for the taxes they paid, not for the duration of their life with Madoff, but for I think the 6 years prior to that. So the IRS did grant them relief for that. The big fine for FTI was for foreign tax accounts, for his foreign investors. When I, as a US citizen, am investing with my investment advisor, they don't withhold money for me because I'm already subject to the jurisdiction of the IRS and the US taxing authorities. International customers are not. So Madoff withheld a portion of gains from his 126 or so foreign account holders, many of which were huge hedge funds. And we noticed a line item on the customer statements that was withholdings for every gain. We then added up those line items on a monthly basis, and we're able to tie that to the wire transfer Madoff paid to the IRS for taxes withheld by foreign account holders. He was paying the taxes because for a fraudster who obviously doesn't want to do things, one of the costs of business for a fraudster is paying taxes on gains you don't actually have because you've been lying. But if you didn't pay, you can't take a tax deduction to say, hey, I lied, so I didn't really earn this income. So we actually got the IRS to give us back $650 million, notice I didn't use only in front of this one, $650 million of taxes that the Madoff enterprise paid the IRS on fake gains. The IRS gave that back, and that went to the recoveries that we could give to the account holders. That was a huge win for us. So the question was, do we think we'll get to the 20 billion and will the saga enter there? One good fact is, even though there's 20 billion in losses, there are a few customers who chose not to file a claim. One of them was a very large hedge fund that just decided they didn't want to subject themselves to the jurisdiction of the US courts, which as a I don't understand that because we sued them anyway, and I don't know how you avoid the jurisdiction of the US courts. But they didn't file a claim, and some international money where I guess in countries like Brazil, they can't legally invest in US companies and things like that, so they didn't want the Brazilian government to know that they found ways to get their money out of Brazil. So there was $2.5 billion of net losses that didn't file claims. So our target is 17.5. But I do think we are going to get there because as I started this by saying, there's still 50 active litigations, and 2 of those 50 are against humongous hedge funds where there's still $3 or $4 billion that we're chasing in those. We've yet to lose a case in court. We have settled along the way and things like that. So I think that over the next 5 to 10 years, we will get to 17.5 and may get closer to 20. I do think we'll get there. One of the comments that was made in January of 2009 when this started, the then president of the Securities Investors Protection Corporation, he was sitting to my right and we're walking him through spreadsheets on the computer. And he stopped and he looked at the whole room of people and he said, you know, remember this someday because yet unborn lawyers will work on this case. He made that statement in January of 2009 before we really knew just the overall magnitude of this. He was totally right. Because right now there's a kid out there who's going to turn 17 in January, who has every aspirations of going on to law school. He's going to get a summer associate job or a job at one of these firms, and is going to work on some aspect of Madoff litigation. And they were born after he made that statement in January of 2009. The magnitude of this case is just, it's mind-boggling, and you know, it certainly is a career highlight for those of us that have been involved in it.
One thing that always slips through that I'll just get you to explain in 5 words or less.
Have you learned nothing?
No, that's too true. There is a cost and the lawyers are involved and we're involved. Who funds that?
In this case, the funds being paid to the professionals, FTI, Baker Hostetler, the other firms, are not coming out of money that's going to the creditors. SIPC is paying the bill. And then people will say, oh, but SIPC, then that's taxpayer money. SIPC is an industry-funded member organization. Every financial institution pays dues to be a member of SIPC. They have been paying dues to SIPC since 1970. And prior to Madoff, there was never, am I over 5 words? There is never a significant matter like this one. So SIPC actually had $1.6 billion in cash reserves when this happened in December of 2008. They had so much money that they didn't need, they stopped charging anything over a nominal amount to the financial institutions. They needed to charge them something so that they had a contractual arrangement. So in 2008, the firm Goldman Sachs, their annual dues to be a member of SIPC were $150. It literally was, they didn't need the money, but they needed the contractual relationship. Obviously now they've started resuming charging fees, and people will say, oh, well, it's still expensive, and consumers are paying for it one way or another, but that's economy. And so this is a huge factor because everybody's like, oh, it's such a great result, but what a shame that the professional fees are taking so much out of what the customers are getting. And in this case, it's not the case.
We're extremely appreciative of you coming halfway around the world to take us through that, Matt. And as you say, litigation continues and the story continues. Please join me in thanking Matt for a
Thank you.